The goal of this video is to educate consumers about TFSAs because financial service providers focus more on promoting their own products than on the general concept of tax-free savings. Hi, I'm Nomtha. On this channel, I create financial education content for you because your financial freedom matters to me. A little intro about TFSAs is that they were introduced in 2015 and they are there to encourage a savings culture in South Africa. If there is only one, not two, not three, not five, but one investment product in a long-term investment portfolio, then it should definitely be a TFSA. Now, there's tons of TFSA providers in the market, and while it's nice to have all those many options, it can also get pretty confusing at times. This video, therefore, seeks to help you narrow down those options for you and help you decide which TFSA provider to go with, whether to open a TFSA with a bank, an insurance company, stockbroker, or even an LISP, which is essentially your linked investment service providers. But enough with the talking, let's dive right in. Banks offer cash-based TFSAs in the form of fixed deposit or call accounts. Okay, they are generally regarded as low risk but no growth in real terms, and by that I mean your money grows at a much slower rate than inflation. Okay, and as you probably know, with low risk comes low returns. All right. Exactly. So you have like a predetermined interest rate that the banks will offer you, and this is almost guaranteed basically. But here's the thing, you always want to compare the interest rate that the bank is offering you to the inflation rate. So what is the inflation rate and what is the interest rate, so that make that calculation and see if it even makes sense to have your TFSA with a bank. But I can tell you right now that a bank is not an ideal place where you would have your TFSA, solely because of those very reasons that I've just mentioned. The fact that your money is in there being eaten away by inflation is not very attractive because your money is getting less. The value of your money is getting less. So hence I say it does not make sense. All right. And then other banks may need monthly minimums and minimum deposits from you, but other banks will only need one of those. Yeah, it just depends on the bank. So you would just have to check what the terms and conditions of that particular bank you wish to open your TFSA with. And last but not least, for the most part, there are no fees with banks, and this is great then. I mean, at least not for the TFSA product itself. So LISPs are basically your linked investment service providers, and they, for the most part, invest in unit trusts, and unit trusts are obviously actively managed. And that is what basically makes them to be expensive. The fact that somebody is there managing them actively, then obviously that person has to be paid. Okay, so there are management fees and there are also platform fees. But it's great that because it's an LISP, you have like a variety of unit trusts to choose from. And then insurers. There are insurance companies that also have TFSAs. Then these are basically like life insurance based TFSAs, sometimes in the form of life wrappers. So I would say that if you are interested in that, and you probably have a life insurance already, just contact that financial advisor that last called you when you were signing up the product, when you were signing you up for the product. Yes, call him and ask him if you are interested. If you are interested in a life insurance based TFSA, exactly. But otherwise, the nice thing about insurance companies is that they have protection from creditors and also tax advantages. And I am quoting from an article that I read from Save Tax Free, and it says proceeds to named beneficiaries are excluded from the deceased estate for the purpose of estate duty. So that explains the tax advantage part of it. So in case of death, you are basically having that kind of an advantage. Okay, and then for the protection from creditors, in case of insolvency. So your TFSA is protected, and this is really cool. Monthly minimums. There are monthly minimums, unfortunately, with for the most part with life insurance based TFSAs. So just check with them if it is something that you would be able to do or to meet up with, if it is a term that you are okay with. So just check the terms and conditions. Maybe if they are saying we need 500 every month from you for this TFSA product, etc. Okay. So, and they invest in unit trusts. Yeah, again, similarly to the LISPs, unit trusts obviously actively managed, and this makes them relatively higher, okay, like in fees. This is the thing. So you have that kind of advantage, but you also have this kind of disadvantage. So the advantage is the protection from creditors and takes advantages, but the disadvantage is the fact that the fees are relatively higher. And stockbrokers, my personal favorite. Stockbrokers basically have broker-based TFSAs in the form of ETFs or exchange-traded funds. Okay, so the performance there is basically dependent on the stock market. Yeah, so there's definitely no guarantees. There are no guarantees. You can make money, you can lose money. But yeah, but there's also a possibility to have paid dividends depending on the kind of ETF that you have purchased. So you would have to check the what they call the fund fact sheet of the ETF to actually see whether that particular ETF pays dividends or not. And also how often does it pay it, annually or quarterly, or what is the issue here. Okay. Yeah, and then you can, I always encourage people to actually you take those dividends and reinvest them, especially if they are in your TFSs, so that you can actually let compounding interest do the magic for you. Okay, and another thing to touch on with the stock market performance, being a very volatile place to put your money, obviously it's riskier. And like I already mentioned with the other one, that low risk means lower returns. Again, here higher risk means higher returns, so you have a potential to make more money here. Okay. But yeah, basically the stock market does depend on macroeconomic activities and microeconomic news, and so there are no guarantees. Okay, but at least you are able to make some money. But another thing again is that for all the risk averse people out there, or those people that are a bit reluctant to take on risk, when you again purchasing the ETF, you can actually check, if you are risk averse, you can go for low risk, but you can also go for medium risk. But yeah, there's like a possibility for low risk, medium risk, or high risk kind of ETF. So that is information you would be interested in. Okay. Yeah, so it doesn't mean that just because now you are risk averse, the stock market is not for you. Okay, just relax a bit. But of course, yeah, you do your own analysis and then you decide what is good for you. This is the whole purpose of the video, after all, to give you all these options. And then at the end of the day, you are the one to make the decision. And then monthly minimums. Here, there are no monthly minimums and there are no monthly deposits. Honey, yes. I love the flexibility here. For the fact that there are no monthly minimums means that if ever there are some changes in your income, then at least you do not have the kind of stress, that stress to say that, oh, every single month you must now be able to have, like, there's some 500 that must pop out from you and you must pay it. You must be, contributing this 500 every single month, that type of thing. So, or even when things are a little bit hard for you financially, temporarily and stuff, but now you just have to have this money to pay. So yeah, so you basically have the kind of flexibility, so that also no monthly deposits or monthly minimum. So yeah, exactly. So in other words, you can do like a once off payment or once off contribution, but you can also do a recurring contributions, as you like, as you see fit. Okay, you do what you want to do. So I love the flexibility in that regard. And last but not least, there are brokerage fees here. Okay. So yeah, obviously they have to make money. just like similar to the other, I think it was LISPs, where you also have to pay for their platform and stuff. Also here it's the case, you obviously have to pay something for the fact that you are using their platform, and they have to make money too, you know. This is a business at the end of the day. So yeah. And then there's but again, okay, there's also an underlying fund fee. So now this is different from ETF to ETF. So the underlying fee just depends on the kind of ETF that you have bought, okay? But the brokerage fees, I can tell you something now, that there are stock brokers that offer like super low fees. In fact, there's this particular one that like offers like super duper low fees, you know, so relatively low fees. So definitely it may be something that, yeah, you definitely want to go for something that has low fees, okay? So because at the end of the day, that means more back for your pocket. Now that you know the difference, it is left for you to decide which TFSA provider to go with, depending on your on what better suits your needs, your risk appetite, as well as your investment time horizon. But also note that it is possible to switch from one TFSA provider to the next, and this process can actually be done internally between the two providers. Just speak to your current and your prospective TFSA provider to know how the process can be done seamlessly. Thank you so much for watching. Let me know if the video has been helpful to you. Share it with your circle. Feel free to leave a comment on the comment section down below, and I will see you in the next one. So bye from me. Cheers.